sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Howe, in for Jack Otter. Coming up, hot potato. January inflation came in higher than expected, dampening hopes of an early rate cut. Investment strategist Chris Heisey shares his insight on what it means for investors. Then, move over Magnificent 7. It's coming down to the Magnificent 1 as investors eye next week's earnings report for NVIDIA, why it could be a make or break moment for the stock market. And later, a look at companies making big moves in a jumpy earnings season. But we begin with our expert panel and 3 things investors ought to be thinking about right now on the Barron's Roundtable. My colleagues, Ben Levison, Al Root, and Elizabeth O'Brien. Ben, let me start with you. Down week for the stock market. We haven't seen a lot of those. The market had gone up 14 out of 15 weeks until this past week. What do you make of this break in the action?
I think it's actually a good thing. I mean, I'm surprised that the market wasn't down more, first of all, just because we had this CPI reading, this inflation reading, and it was hot, and it was not what people had wanted, and the market had a pretty big sell-off on Tuesday when this happened. But it made back most of the gains. It had a kind of an off Friday thanks to producer price index, another form of inflation being a little hotter than normal, but still relatively flat. We've had a great year so far, up more than 5% the S&P 500. I think it's looking okay.
If the hotter inflation means that rate cuts are delayed, what do you think that means for bonds?
Well, I think for bonds, we're already seeing this happen, where you're getting the 10-year yield. It was stuck in a range between like 3.8% and 4.25%. Now it's broken above that 4.25. And if the data keeps coming out hotter than expected, both the economic data about how strong the economy is, but also the inflation data, you're going to see those yields go higher.
What should I be watching for the week ahead?
I'd be watching 2 things. One is for earnings. We're going to get NVIDIA and others. And
the most important economic indicator, as we'll talk about.
Yes, very true.
Earnings for NVIDIA.
But we're also going to get the FOMC minutes on Wednesday, and we're going to get to hear a little more about what the Fed is thinking about and what we're going to need to see in terms of those rate cuts and whatnot.
Got it. Al, for the first time in about as long as I can recall, I can almost describe what General Electric does for money. There's no more light bulbs, there's no more microwave ovens, no show business, no mortgages. The MRI machines have already been spun off.
Yep.
And there's one more split coming, and we got some fresh information about that this past week. Tell me about it.
Yeah, exactly. And it really is amazing. It's almost this deconglomeratization. You can actually understand it now. So GE filed a form with the SEC to give us more financial detail about the SpinCo.
Yeah.
The spin company is going to be the power business, and what the rest of GE will become GE Aerospace. So that's the last 2 companies that will bear the GE.
And that'll happen.
So it's not official. It'll probably happen early in the second quarter,
Yep.
like April 1st, April 2nd time frame. I would recommend not April 1st, but they're not going to ask me. And then we have 2 analyst days in early March where the management will talk about these businesses.
Okay. And if I have GE and I'm going to end up with these 2 pieces, GE Aerospace, what do I make of that? Is this a good business?
Great business. It's the gold standard, leading market share in jet engines. Excellent.
Those are important for jets.
Very important for jets. Number 1 producer worldwide. Very strong performance. Ramping free cash flow, excellent performer. That's the bulk of the value here.
The other piece is called GE Vernova. Vernova sounds made up and vaguely sunny, but this is like the business of burning natural gas to make power, and also wind turbines and lots of other things. Is this a good business?
So this is the turnaround, right? So it's losing money. It lost money in 2023. We're looking at maybe a break-even year in 2024. They do generate some free cash flow. They've turned around that gas business, so it's a reasonable performer. The wind business is the one that is consistently losing money. The job of that management team will be to turn it around, expand margins, and prove to us all that making wind turbines can make money.
Do you keep that part of the stock?
I keep it.
Okay.
I keep them all. It's just the easier way to do it.
Elizabeth, there are early estimates in for the raise that seniors are going to get on their Social Security checks at the end of this year, and there's some sharp disagreement on it. Tell me about that.
That's right, Jack. This past week, the Senior Citizens League came in at 1.75%. The Congressional Budget Office came in at 2.5%. Now, there's some different methodologies underlying those estimates, different assumptions. But it's suffice it to say that if we continue on this track, it is going to be less than seniors have been accustomed to over the past 3 years.
They got this year, correct me if I'm wrong, more than 3%, and last year it was over 8%? So
exactly. This year was 3.2%. Last year was a whopping 8.7% because we had a really hot inflation in 2022. Now, it's early days. We're not going to know the actual COLA until October, but it's trending lower. It's closer to the historic average.
So coming between those two estimates, let's say it's a 2% raise. There are folks who are going to be watching this show saying, my costs right now are through the roof. I feel like my costs are up 10%. Why are we talking about a 2% raise? How do we explain that sort of disagreement?
Yeah, that's a great question because people really are still feeling the squeeze at the grocery store. Now, inflation might be moderating. Price growth is slowing. But that doesn't mean maybe less than people expected, but it's still moderating. That doesn't mean that prices are falling. On some categories, they are not across the board. People are still feeling the pinch for sure.
Elizabeth, Ben, Al, thank you all. The Fed is feeling the inflation crunch or squeeze. Call it a scrunch. Chief Investment Officer of Merrill and Bank of America Private Bank, Chris Heisey, tells us what a delay in rate cuts means for investors and the economy. That's next. January inflation data has investors further trimming hopes of a rate cut early this year. The futures market now pricing in a 74% chance for a cut in June. Consumer prices up slightly more than 3% from 1 year ago. That's down from December's rate, but still higher than expected. Wholesale inflation also topping forecasts, up nearly 1%. Joining me now is the Chief Investment Officer of Merrill and Bank of America Private Bank, Chris Heisey. Chris, do you agree with the percentage that we just showed? Is a rate cut off the table for now? And can the stock market keep performing without one?
Well, I think for those that have been in the markets for quite a long period of time, there's in the Fed funds futures market, there's more head fakes than on a basketball court. So, we got to watch the market. We have to pay attention to what futures say. But is it off for March? It looks that way. We have 4 more inflation prints to June, so 74% chance, that feels about right, and it might get pushed to July, but it's the reasoning behind the cut that matters more than the actual timing.
What pockets of the stock market should investors be favoring right here?
We have this push and pull going on. When good news is bad news. Bad news might be good news.
I always wonder, is good news still good news or bad news? How do you figure it out?
It looks like the market's pricing both to the upside. So you get a little bit of good news, and they're happy because that filters down into earnings, as long as yields don't continue to go up. So the key is to have decent news with inflation coming down and yields coming back down, and that is more supportive of a full rotation in the market.
And what parts of the market you think can shine?
This year is a big difference than last year. We still have the narrow leadership. It's obvious. You can call it the Super Six now, the Fantastic Five, or whatever you want to call it. But if you move out there, you're starting to see less of a downside in the rest of the market when there are weak days. That's the critical part. So it looks like asset management community is starting to rotation. In the sector side of the equation, I would look at energy. Energy's starting to catch a little bit of a bid right now. It didn't do so well last year. I'd stay away from the more defensive sectors, utilities, consumer staples. When I say stay away, you have a little bit less exposure. Keep a balanced approach in technology. You don't want to be underweight innovation. And then you look at discretionary, which is consumers a little tired, but still spending, particularly on services. And last but not least, industrial seems to be broadening out.
Do bonds look tasty here or not really? Are there parts of the market that are more attractive than the rest?
The most important thing about bonds on a go-forward basis, because we do believe we're going back in time, is it's called fixed income for a reason. You want to look at bonds for fixed income, not this total return approach in the last 30 years that have given you. So, yes, bonds still look attractive. They are a ballast in the portfolio. You're going to start to see a little bit of correlation changes going on between that and equities over the next few years. Credit spreads are coming in. They're a little too tight. I would stay high quality across the board. And in the equity market, small caps are now starting to get a little bit more fanfare out there.
You mentioned going back in time. You've said that the next business cycle could resemble the 1990s. My wardrobe is ready. What do you mean by this?
Yeah, I think it's important to take a look at all things from the 1990s, including wardrobes, music, entertainment. But in terms of what's going on in the business cycle, you're seeing an adjustment in yields that are getting back to what the normal yield curve was back then. Inflation, same thing, between 2 and 3% once we kind of settle down. The actual steepness of the yield curve overall, geopolitical equation, people forget that you go back then. Unfortunately, that's when the Middle East really started to pick up back then. Terrible situation, but very similar to back then. And then you look at the earnings and the production of a new profit cycle off of something called an innovation wave. Back then it was the internet, now it's generative AI.
This is a presidential election year, I've heard. Can I ignore the politics when I'm putting together my portfolio? Is there anything different I should be doing?
I don't know how you're going to be able to ignore the politics because it's going to be out there most likely late spring all the way through the election. When you talk about stock market, you talk about diversified portfolios, portfolio management, rebalancing, disciplined way to think about matching your goals. Yes, you do somewhat ignore the politics, but you do have to factor in the mindset you're going to see a little bit more volatility in election years, but they tend to be positive, double-digit positive with a high hit rate. So you can ignore them the best way you can, but you still have to kind of make sure that you understand that it's going to be a little bit more volatile.
We got about 20 seconds here. You've called commercial real estate a key wild card for the market. We're talking mainly about office real estate. What are you worried about here?
Mainly on the office side, and it's really the debt maturities that are coming due. Many properties that and loans that were placed out there in the marketplace at much lower interest rates will now have to be refinanced at a much higher interest rate. So that's why the credit sensitivity in the economy isn't big, but the interest rate sensitivity in that part of the market, the real estate market, is very important.
Chris Heisey, always nice to talk with you. Thank you.
You too, Jack.
One tech company has the power to determine the direction of the market, and investors are watching ahead of its fourth quarter earnings report next week. We'll take a look at what's at stake for NVIDIA next. We'll move over Magnificent 7. NVIDIA is proving to be the Magnificent 1 that's dominating Wall Street. With the company set to report earnings on Wednesday, the direction of the entire market hangs in the balance. I'm going to read you guys some fun facts. NVIDIA has multiplied 18 times in price over 5 years. It's tripled over just the past year. It passed Amazon and Alphabet in market value to become the third largest company behind Microsoft and Apple. And what that means is if you're looking at your 401k and you like that 20% plus return that you've seen in your index fund, you have NVIDIA to thank for it, and we should probably pay close attention to those earnings. So Al, tell me first of all, does NVIDIA stock look too expensive to you right here?
No, almost incredibly no. You gave those stats, right? 1,800% over the last 5 years. Think about this. At the start of the run, it traded for 33 times earnings. Right now, it trades for 35 times earnings. All of those gains have been justified by these incredible expansion in earnings. Go back to 1995, Intel, 95 to 2000. 900% gain. It started that run at 15 times earnings. It ended the run at 44 times earnings. So while you want to say bubble, you can't. It's too easy to say bubble.
The earnings are driving the stock price. It's not froth.
Although there are signs of froth, because I have a trainer, I know. Can you imagine?
Trainer as in gym, as in at the gym. Okay,
and
I'm interested.
He said to me the other day, "Hey,
Act it out. You're at the squat rack."
Yep.
Go ahead.
And he says, "Oh, I bought some NVDA," and I went, "Oh, that's great." And he's like, "Yeah, NVDA." You know what? I was like, "NVIDIA." He wasn't actually sure what the name of the company was.
The name. That's probably not.
At least it wasn't your cab driver.
The first part was more comforting. I'll tell you about the upcoming earnings report. Data center revenue is expected to have tripled over the past year. The total revenue estimate for the fourth quarter is $20 billion, but analysts are raising at the last minute $23 billion and more. There's been this key shortage of manufacturing capacity, and that bottleneck seems to have eased. One analyst I spoke with said NVIDIA really has to thread the needle on its earnings call. They have to convince investors that as this new supply comes online, that demand will keep up, and that could be pivotal for the market. Ben, what do you think?
Well, I think the important thing here to remember is that this isn't just about NVIDIA. All the AI stocks out there, everything that's gone up because there's hope that AI is going to drive their business, is going to react to these earnings. So if NVIDIA comes out and there's any sign of slowing there, it might not just hurt its stock, which would be bad enough given how large it is, but almost everything else that has AI exposure could get hit too, and that could pull down the market.
Elizabeth, you say that some investors could have more AI exposure exposure than they realize or more than they want.
Yeah, that's right, Jack. In fact, I had a young reader write to me last year seeking feedback on his portfolio. He owned the S&P 500 and some Microsoft on the side. Now, Microsoft represents about 7% of the S&P 500 due to the market cap weighting of the index. So if you're owning, the index and Microsoft on the side, you're making a pretty big bet on technology. In fact, people say the technology weighting of the S&P 500 is about 30%, maybe even closer to 40. So he was making a pretty concentrated bet. Now, if you're bullish, you love the sector, great. If you're not comfortable with such a concentration, get a total market index, get some small cap stocks in there, spread it around a bit.
I thought you were going to tell me you had 50% Bitcoin, 50% Nvidia. So not as bad
No,
as
he
I
was a
thought.
sensible young man. No.
But even small caps you have to worry about a little bit. There's this company called Super Microcomputer that I never heard of until recently. Up 200% through Thursday's close because it's AI. It's connected to NVIDIA in some weird way that I don't quite understand. But it's a small cap that's now worth $56 billion. And it is accounted for about 3/4 of small cap gains this year, which is just wild. So you have to be careful even when you're looking at other parts of the market.
I want to tell you about a conversation I had this past week with an analyst. He drew key parallels between NVIDIA and Apple. The iPhone market proved bigger than anyone expected. It replaced everything in cell phones. It changed the cell phone market. And the accelerator, NVIDIA makes these accelerator chips for servers. And as AI makes its way into new kinds of software, that market is proving huge too. He says that in 10 years, unaccelerated servers will be the flip phones of the data center. In other words, you're going to need NVIDIA stuff everywhere and stuff from its rival AMD. He also pointed out that NVIDIA's robust software ecosystem and growing services business resemble Apple. Ben, agree?
Well, if I was going to look at the other side of it, this is more like maybe Cisco. At least that's what some of the bears are out there saying.
That is not nearly as. Go ahead.
So let me remind people, Cisco was the darling of the internet boom. It was making the routers that it was going to make everything run, and it went up and up and up. The valuation got to nosebleed levels. The bubble popped, and the stock, it's been a good business. It keeps making money. It's doing good stuff, but the stock has never gotten back to those previous levels. It just inflated too much, the valuation. And I think when you think about a bear case for NVIDIA, that's what you have to worry about, is that it's making the chips right now, but at some point there'll be others making chips, and they'll become commoditized, and then you have an issue.
I'm hoping it's an Apple and not a Cisco for the sake of all of our 401ks and index funds. Thank you all. Coming up, Elizabeth and Al have a pair of investment ideas, and Ben explains what to make of a jumpy earnings season. Stay right there. So, Ben, Lyft had an earnings report typo this past week, and the stock shot up. And you say there's been a lot of jumpiness around earnings. Tell me about that.
Yeah, I mean, this Lyft earnings report was fantastic. They put out the press release. They say their margins are going to increase by 500 basis points. That's 5 percentage points for people who don't speak financial.
Yes.
And it turns out that there was an extra zero in there. It was supposed to be 50 basis points or 0.5 percentage point. The stock initially jumped 60%. A huge move. What was crazy about this is it dropped back down, but at the 2 days after the earnings, the stock was up almost 60%. Despite this typo, that was not true. But the thing that's crazy is that you don't need to have a typo in your earnings to actually have big moves right now. We looked at Shake Shack this week.
I'm familiar with their products.
We like their burgers, right? 26% gain after earnings. Then you look at something like Roku, which released last night. A little problem there. It's down 23%. And I don't like to just trust my feelings about things. It seems like it's a little more volatile. I reached out to a company called 22V, which is one of my favorite research firms. They looked at the numbers for me, and they said that, you know what, this is one of the more volatile earnings seasons. And it, I think, can be chalked up to two things. One, everyone is really bearish on the economy, and the economy hasn't been as bad as people thought. So some companies are coming out with earnings that are really much better than expected. They're getting big moves up. But then you have these other companies that are tied to more thematic things like AI and whatnot, and sometimes they just can't deliver the numbers, and they're getting punished. And so we're going to see, I think, this play out for a little bit longer, but maybe it'll get more normal next time.
It doesn't just feel nutty, it is statistically nutty. You heard it from Ben. Al, tell us about a stock we should be interested in.
I like L3 Harris Technologies, ticker LHX. It's defense.
Yeah.
Defense has been actually pretty bad. Of the biggest 6 defense stocks in the U.S. market, 5 of them are down over the last 12 months, including LHX. That's one of the reasons there's an activist investor in there now, D.E. Shaw. They came to an agreement in December. They got 2 board members. The old CEO is running a business process to improve things. LHX.
Elizabeth.
Yep, I'm looking at Digital Bridge Group, ticker symbol DBRG. Say that 3 times fast. Now, this is a company that is morphing from a data center REIT to an asset manager, and our colleague Bill Alpert wrote about it in this week's Barron's magazine. He said there could be 50% upside.
If it goes down, it was Bill's idea. If it goes up, you knew it all along, Elizabeth.
I'll take the credit.
Ben, Al, Elizabeth, great ideas, and thank you. To read more, check out this week's edition at barrons.com. Don't forget to follow us on X. That's at Barrons Online. That's all for us. See you next week on Barron's Roundtable.